A discounted cash flow model can be used to determine a company's fair value, and that may be a buy the dip opportunity. Hold on to your seatbelts, folks. This is going to be a good one. A discounted cash flow model, or DCF, is a way to create an estimate of the value of an investment based on its future cash flows. This model takes into account the time value of money, meaning it adjusts future cash flows to reflect the fact that money available today, well, it's worth more than the same amount in the future due to its earning capacity. It then calculates the fair present value of expected future cash flows by discounting them at a rate that reflects the risk associated with those cash flows. The fair value can be useful in finding those buy the dip opportunities. When the fair value is significantly higher than the current market value, it could indicate that the investment is currently undervalued and thus may present a good buying opportunity. However, it's kind of important to remember that this is but one method of valuation, and even if a company looks very undervalued, you still need to do your due diligence before you plop any money on that table. DCF calculations can become very complex, but I will share with you the very basic calculation to give you an idea of how it is all done. First, we need to project future cash flows, so we will estimate the cash flows the investment is expected to generate in each year of the projection period. For stable companies, that is usually a projection period of 5 to 10 years. Newer high growth companies can use a much shorter period, such as 3 to 5 years. Our next step is to choose a discount rate which should consider the time and risk of the asset. If you are expecting a 5% return on a riskier stock, you may want to take that into account with a 10% discount rate. Once we have our discount rate, we now need to calculate the present value for each cash flow, which means, if you remember that period, each year in that period. To do that, we use a formula. PV equals CF over 1 plus R raised to the power of N. In that formula, PV is your present value, CF is the cash flow, R is that discount rate, and N is the year number. So if we're calculating it for the third year, we would use a 3, or the second year would be a 2. If cash flow in year 2, for example, is $1,000 with a 10% discount rate, your present value would be PV equals 1,000 over 1 plus 0.10, with that bottom part all raised to the exponent of 2. Add that all together, we get $826.45. In the final step, you take all of the values for each cash flow. So if you did that 5-year period, you should have 5 values here, and you're going to average them out, and that gives you your fair value. There is a good amount of math, and it can even get more complicated if you want a little more accuracy, where you do not estimate the discount rate, as there is another formula for that as well. No worries though, we are not going down that rabbit hole for this video. Join the conversation. Let us know in the comments if you have been using the DCF as part of your due diligence. Your participation is, as always, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. Now that we have a grasp on that discounted cash flow model, we're going to look at some companies that are well undervalued and see if perhaps some of them might make a good, well, buy the dip opportunity. We are sticking with blue chip investments for this list, and we will pull our companies from 5 different sectors and see what we end up with. Kicking off this list, we are going to start with the energy sector, and the company we are looking at is Imperial Oil Limited with a ticker of IMO. They are one of Canada's big oil companies with upstream operations as well as petroleum refining and marketing. They have a pretty healthy market cap, $35.22 billion. Their beta a little on the volatile side at 1.89, and they've got a healthy EPS of 11.86. Their price to earnings ratio, that comes in at 5.20. Their current value, now that comes in at $65.42. Using that discounted cash flow model, we get a fair value of $80.66. That means they're undervalued by 23.3%. Not too bad. Okay, let's take a quick look at their returns. So they do have a dividend with a yield of 3.057%. It is a quarterly payout, 50 cents per share, with a payout ratio of 13.20%. When we look at their returns over the 3 years, their return on investment has been 197.77%. Add in those dividends, we get a total return of 215.38%. Holy banana bread! And that is the biggest return on today's list, by the way. Their 1-year return on investment comes in at 17.56%. Adding in dividends, we get 20.65% as our total return. For 2023, they faltered a little bit because oil's been down a little bit. So their return on investment comes in at negative 0.41% with a total return of 1.02%. With the energy sector, after the recent boom, it can seem hard to really call them a buy the dip opportunity, but they have been falling and they will more than likely rise again. So this, well, that's the definition of a dip. Imperial Oil is not the only oil player in this game. Tourmaline was a close second with an undervalued amount of 22.9%. Good old PPL came in third with 20.6% undervalued. Okay. Our next sector at number 4 is the banking sector. And for the banks, the most undervalued of the lot was CIBC with the ticker of CM. It is no big secret that the Canadian Big Six have had a rough ride, and there may still be more pain ahead. CIBC is totally at the bottom or has more room to recover when the sector rebounds. They have a nice looking market cap at $51.25 billion, fairly average beta of 0.98. Their earnings per share comes in at 5.21, and they got a PE ratio of 10.40. Let's look at their value. Their current value comes in at 55.84. Fair value comes in at 81.92. That gives them an undervalued amount of 46.7%. That's not too shabby. Well, it kind of sucks, but it's not too shabby when you're looking at room to grow. When we look at their dividends, they've got a nice looking yield of 6.232%. That is paid out quarterly, 87 cents per share, and their payout ratio, well, that comes in at 64.74%. When we look at their returns, their 3-year return on investment, that comes in at 19.52%. With the dividends, we get 39.83%. That 1-year return on investment, that comes in at, well, this is where the banks really started to falter, negative 11.39% for a total return of negative 6%. In 2023, there has been a little bit of recovery in the banking sector, and we can see this with their return of investment coming in at 1.09%, total return of 4.20%. I know that you are all curious about the other 5 banks because everybody has their favorites, right? Scotiabank, they came in at 38.3%, BMO at 35%, TD at 30.6%, National Bank at 28.8%, and finally, Royal Bank came in with 25.2%. Coming in at number 3 is the healthcare sector, and representing, we have Sun Life Financial with a ticker of SLF. They are one of Canada's top 3 life insurance companies, and this is a sector definitely primed for a breakout in the bull market. Their market cap, it comes in at $39.68 billion. Once again, another pretty average beta of 0.98. Their earnings per share comes in at 5.13, and they have a price to earnings ratio of 12.40. When we look at their current value, they're listed at $67.63. Their fair value comes in at $104.22. That makes them undervalued by 54.1%. That's not too shabby. Once again, I'm cheering for who's doing the worst, but hey, that's the theme. Let's take a look at their yield. That comes in at 4.436%. It's a quarterly dividend payout of 75 cents per share, and their payout ratio comes in at 51.74%. When we look at their returns, their 3-year return on investment comes in at 27.41%, and they have a total return of 41.80%. On the 1 year, the return of investment comes in at 15.47% with a total return of 20.39%. And so far, in 2023, their return on investment comes in at 6.84%. Adding in the dividends, we get a total return of 9.16%. That is actually better than the market. So pretty darn good. Our other 2 big insurance companies are in a similar boat. Manulife Financial is at 48.7% undervalued, and Great-West Life, they're coming in at 43.7%. In our almost top spot at number 2, we have the communication sector, and when it comes to Canada's big 3, they have a wee bit of pain going on. Rogers has a ticker of RSI.B, and they will be representing this sector. Rogers market cap, it comes in at $31.82 billion, and they have a, well, almost half as less volatile as the market average beta of 0.41. Their earnings per share come in at 1.01, and they have a price to earning ratio of 19.0. Their current value comes in at $60.20, and their fair value comes in at $93.31. That makes them undervalued by 55%. When it comes to yield, they provide a 3.322% yield that is paid out quarterly in the amount of 50 cents per share. Their payout ratio comes in at 56.50%. Looking at their returns on the 3-year, their return on investment came in at 5.69% for a total return of 16.22%. On the 1-year, we get a return on investment of negative 1.05% for a total return of 2.24%. Looking this year in 2023, not a good year for Rogers. Their return on investment has been negative 5.20%. Total return still in the negative at negative 3.62%. But a lot of that is all of the drama around the merger with Shaw. Looking at the other two of the big three, Bell comes in at 54.7% undervalued and TELUS comes in at 41.4% undervalued. In our top spot at number 1, we have the Canadian tech sector, and without much surprise, Shopify leads that charge with a ticker of SHOP. Their market cap comes in at a very nice $98.41 billion. They've got a beta of 1.82, so there is a little volatility here. Their earnings per share comes in at 0.05. They do not have a price to earnings ratio, so that is one we can't really look at. Well, let's look at their value. Their current value comes in at $81.90. They have a fair value of $147.77. That makes them undervalued by 80.43%. Holy banana bread. They do not have any dividends, so we don't have to worry about their yield. Their 3-year return on investment is negative 35.05%. And you guys all remember back in the pandemic, we had that big fall when it came to Shopify, and that's part of that negative 35.05. They have been rebounding ever since. So their 1-year return on investment is 93.66%, and their 2023 return on investment is 67.86%. They are doing well, they're moving in the right direction, and they're very much undervalued, so they have a lot of room to climb. The other big company in Canada's tech sector is undeniably Constellation Software, and they're only undervalued by 4.7%. Shopify pretty much dominates the show when it comes to tech recovery in Canada. From the companies we looked at today, they are mostly blue chip and safer bets as a result. The bear market delivered a lot of pain to the TSX, and there are plenty of buy the dip opportunities for sure. Some people do believe that the bottom isn't in yet, and there is evidence for that, but how much lower will we go? What if we don't drop? It is questions like these that shows the importance of dollar cost averaging. It is hard to buy the dip at that exact bottom, and with that in mind, it is never a bad idea to dollar cost average when you are dip adjacent. Whether you think the dip is now, last October, or yet to come, when we get to the height of the bull market, all of these options have made, well, some nice looking profits. Keep the learning going. Watch my video on WCN or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.